Good morning. We will go ahead and call our MAPS Investment and Operating Trust meeting for February 20th, 2023 to order. Item 2, approval of the minutes. They were included in your packet, so if you have any changes or corrections, please say so. If not, I'll take a motion in a second. All those in favor, please vote. Or all those, everybody vote, sorry. The last few trust or MAPS meetings, we've had to do verbal voting, so sorry. Yes, all right, motion passes, thank you. Okay, moving on to 3 items for individual consideration. A, presentation of the quarterly investment report for the period ending December 31st, 2022. Doug Anderson from & is here to present. Good morning, Doug, how are you?
Good, I'm well, thank you. Thanks for asking. Good morning, everyone. Madam Chairperson and trustees, I'm going to try to drive the presentation this time. First time I've done this, but hopefully it'll all work out. So what we'll be looking at is the 1231 report, and then we'll look at a 131 update, and then a few pieces of market information. They'll give us some more context on what's been going on and what we might see going forward. We're still short of 1 year of performance history. If we remember back, we started about April 1 of last year is where we targeted, and last year was not the best year to start an investment program like this. And I'll talk a bit more about that. Let's see, am I doing this? Do I roll? There we are. The first slide here, and I'm obliged to introduce this, is our firm update from our CEO, Mike Welker. A lot of history about our firm. We continue to grow. We continue to prosper by doing what our clients need us to do for them. A few highlights is that it's not listed extensively on this page, but as a result of everything that we do, of all the people, of all the resources that we invest for our clients, is that we were named one of the top 3 mid-sized investment consultants in the world. We like to be mid-sized because to be large, you're usually owned by a very large bank or more often a large insurance company, and that's not the business model we have. Our business model is to be more in line with our clients, and just to remind everyone, we're paid only by our clients. We have no conflicts of interest because no one else is paying us to do what we do or say what we say. So our interest is your interest in that case, and it's something that we're committed to. So here's a little nightstand reading. Hopefully you don't need that, but if you do, here it is. Next slide here. That's our organizational chart you'll see here. This is who we are. It's a very siloed organization, meaning I have one job. I don't run the company like I used to at the old place and do the consulting. I just do consulting. You can see our performance reporting section, our partnership, our leadership and management, and then our research staff. Research is something that firms our size sometimes skimp on, but it's not something that we do. We have a lot of folks here who are dedicated to individual asset categories, which we think is the right way to do it. Consulting, you can see my name up here. There's one change this year on my name. Let's see, where am I? Anyway, it shows that I am now a CPFA. I have some new letters behind my name. It's a certified plan fiduciary advisors. That means that I have the credentials that I know what I'm talking about now. Whereas I've only been doing this since the early 1990s, so there is that. But you see our operations staff, human resources, compliance, solutions and growth. So we are we have a lot of resources that firms our size traditionally do not have. We are built for the future in that way. You can see market environment here. I think we all know we're going to go through the painful part of reminding ourselves how tough last year was. Remember, we started at 4/1 of last year, so we had 3 quarters of the year. We didn't have the first quarter of last year. But the nice thing is the fourth quarter of last year saw the clouds sort of part a little bit. The worst of inflation tended to look like it was rolling over, and it looked like there were some issues with worldwide growth that were going to start favoring economies rather than just pushing them down. So in the top chart there, you can see the quarterly performance for S&P 500, which is The U.S. equity market up 7.6%. You can see that next segment there, MSCI ACWI, that's the all country world, ex-US, so that's all the countries outside of the United States. Their equity market's up 14% for the quarter. And hopefully you will recall that when we're looking at market cycles, when markets go from being very bad to not so bad, they tend to perform very well in the short term, right? So when the markets are the most depressing, when you're looking at the last year return and it looks the most challenging, you're probably this close to seeing the best days of the equity market start again. So that's why we stay fully invested. We're not market timers. We try to spend time in the market to generate the returns. And if you do, I'll show one chart in a minute, that if you miss the 5 best days of a market cycle, it's incredibly damaging to your long-term returns. So looking at this list here, you can see that U.S. equities positive during the quarter, non-U.S. equities very strong in the fourth quarter of last year, and bonds were positive. However, when we look at the calendar year, it was a tough year. The only thing that really made money was 3-month T-bills, so risk-free assets. If you look at U.S. equities, down 18%, non-U.S. equities down comparable. But really the standout unusual period or unusual asset class returns were bonds. Bonds started the year with low yields. Inflation was the worry. Bond yields went up. Inflation is kryptonite for bond prices, and we see the worst year bond performance on record in modern American history. We had 2 years that were comparable, but one of those was at the end of the Revolutionary War, and the other one was during the Civil War, and it was an idea that the U.S. government might not be around to pay those bonds. That's the only thing that was comparable to this. I think we're not dealing with that. Maybe the market overreacted a little bit. 7% inflation, not exactly apocalyptic, but markets do what they do, and they tend to overreact both on the downside and on the upside. So moving forward from here, equity markets did change. Value stocks did better than growth stocks. Back to basics. Energy stocks of all kinds. Banks, insurance companies did much better than, say, your Facebooks and your Netflix and your Amazons, just because people were retrenching last year. And we went from spending a lot of money on consumer discretionary to consumer staples. And if you look at the individual sectors of the marketplace, it's very much shown here. Last year was a tumultuous year in the commodities markets. It was a tumultuous year in the energy markets. And the big thing there is the war in Ukraine, right? Russia is a large producer of oil and natural gas, and we all saw the disruption caused by that. The only other sector to have a positive return for the last year were utilities, and that is the most defensive sector out here. Now, do you recall that energy was the most overlooked and disliked sector in the market before last year, for the previous 10 years or so? And when the going went very tough last year, again, we went back to basics. We've got to keep the heat on. We've got to be able to drive to work. We've got to keep electricity flowing. And so that's why the market favored those areas. Looking into international equity, there are a lot of changes going on right now. Obviously, Eastern Europe, the conflict there. China emerging from COVID lockdowns is a huge issue. Will that be inflationary because there's more Chinese demand for raw materials, or will it be deflationary because we're now able to buy goods from China that have been effectively off the market? If you remember the last year, very early before the war started, the biggest market inflation argument was supply chain issues, right? Nothing was coming out of China. Nothing was being offloaded on our ports. And so that is a big change going on right now. Now, you'll see that the U.S. dollar performance versus local performance is in that top chart for the quarter. And notice that they are significantly different. And notice it is significantly different and better if you held shares in foreign countries with U.S. dollars, right? If you're a dollar-based investor owning shares overseas, during the fourth quarter, your returns were much better because the dollar weakened during the fourth quarter. The rest of the year, the dollar was appreciating versus other currencies, and it produced exactly the opposite pattern below. So US dollar, if you hold European and Middle Eastern shares during the fourth quarter, in local currencies, 10.3%, in US dollar terms, 19%. So significant diversification benefit finally from non-US equities, which we haven't seen in, again, a decade. Not going to talk about much here except for on the emerging markets. Russia is no longer there. Russia was deleted from that benchmark a few days after the invasion. It was about a 4% position in the emerging markets. You cannot, if you own shares in Russia as a US-based investor, you can't trade them. They've been written down to zero, and we will see if that ever resolves itself. Also note in the emerging markets benchmark right down here, China and Japan make up about 13% of that benchmark, which is 28% of the overall. So that is the biggest concentration of assets is China and Taiwan. So if something untoward happens there, then that will be a dangerous part of the benchmark. So looking at bonds, again, bonds were awful last year. There's no way to sugarcoat it. Bonds are not supposed to go down 12%, but they were down significantly worse than that. TIPS, which are Treasury inflation-protected securities. Remember, bonds, the kryptonite to bond prices is inflation. TIPS are supposed to guard against inflation. They were down 12% last year because the inflation expectations kept rising and rising and rising. If you look at Treasury bonds, we're down 12.5%. Corporate investment grade for the whole year, we're down 15.8%. And as you might expect, bond prices or bond performance was worse the lower quality bonds you held. So tough year. Short duration was the place to be. The only part of the bond market that made money last year was money market funds. So very, very short duration because as the yield curve rose and got us into an interesting environment where we are now, which is an inverted yield curve. Right here shows you the yield of various duration or maturity of Treasury issues. And notice that from the blue line, which is 3/31 of last year, everything shifted up dramatically. This is what happens when the Federal Reserve raises short-term interest rates by more than 4% in a one-year period of time. Everything shifts higher. But the bond market is also predicting an economic slowdown, if not outright recession. And that's why you see this inverted yield curve, meaning you are paid more in interest owning a one-year bond than a 30-year bond, which is typically the case. Longer duration, the more maturity risk you take, the more you're going to demand in return. But what this is saying is, no, the next 2 years might be a slowdown. After that, we're expecting things to come back. But again, this is all conjecture, it's all forecast, it's all the market, the democratic market, people voting with their dollars saying this. And the other thing is that the WAGs will say the yield curve inversions have forecasted 7 out of the last 5 recessions, meaning sometimes it does invert and we don't have a recession. But almost all recessions are preceded by an inverted yield curve. So that's market environment. Stay with me here a little bit longer here. Again, we started investing at the end of March of last year. That's why you see the huge increase. The corpus, or the principal, if you will, is the gray area, which there were no further allocations after the first one last year. You can see that at the end of the year, that was $79,905. There were some expenses paid out of that. You will see that the market value of the investments was $72.6 million. So we're below. This aggregates all of all 5 of the underlying portfolios into one big one for reporting cases. You can see contributions were $80 million, withdrawals of $95,000. So the loss for that year-to-date period was $7.3 million. And that was a return of negative 10.27. So again, tough year. It is good to see that we had income of almost $1.5 million, which stabilized it even in a tough year. Asset allocation is stable and very close to targets. And again, to remind ourselves, we are not hyper-risk oriented here. We're starting out lower risk and over time building into the return potential of the portfolio. So we've got about 60% equity and then 40% in fixed income. And you'll notice that we also are carrying some cash here. Cash is an investment alternative. It's considered part of the bond portfolio, But remember the inverted yield curve, you can get paid a little bit more than 4% interest with no risk on the cash part of the portfolio. So we think that's an adequate place to have part of the portfolio. Again, very simple. This is early days in the portfolio, but it's a very simple structure. Our largest portfolio is fixed income. Then we have an index fund. We have actually 4 index funds. There are the next largest. And then we have a high yield bond fund and then the cash portfolio. So a lot of exposures to different markets passively, although our fixed income exposure is actively managed. Here is during the quarter, the last quarter of the fourth quarter of last year, income and capital appreciation there at the top level showing where the money came from. Everything was positive during the fourth quarter of last year. And we had appreciation of $3.6 million, and we had income of $735,000. A lot of numbers on this page. Want to talk about our total return of 6.4% during the quarter. Since inception, down 10.27, right? So we're working at slowly making up or gradually making that up. We're not going to do anything drastic to try to make it up in a short period of time. That's not how long-term investors act. If we look at the index funds, the domestic equity index funds, all of them since inception track their benchmark very closely, and they all look very good versus their peer universe. If we look at our international equity index fund here, it doubled the return of most of our U.S. equity portfolios, and it did track very closely across the board, and it is positive since inception. That's inception of the fund. That's not inception of our investment in it. Here is the since inception down 10.7%. Our fixed income portfolios also suffered, but not quite as badly as we might have feared. You can see for the quarter, Dodge & Cox was up 2.76. PGIM, the high yield fund, was up 3.63%. And for the fourth quarter, that entire portfolio was up 2.93%. So, and then our money market fund, 3.16. So that's the portfolio. It is early days. We had a downturn at the very beginning, a drawdown. We are making that up. As of last Friday, we were about $76.3 million. So we're stabilizing where we are. But it will take some time. Looking at I want to go a couple of slides here. Here are the fees. Our estimated fee manager expenses is 18 basis points. That is very inexpensive. We are not overpaying from investment management whatsoever. Most funds about this side would be probably 3 times that much if we didn't have the passive exposure. And our fixed income exposure is very inexpensive also. That's our benchmark, and as far as that is the short version of it. I'm happy to answer any questions.
Doug, I have a quick question about on page 19 where you talked about the active managers for the fixed income. I see that the alpha creation is just over 100 basis points, but in a regular environment, what's the expectation from the active managers as far as that additional alpha? Sure.
It depends according to what the market is like. Right now, we're in a market environment, and I will say that the added value from Dodge & Cox, primarily they're your bigger bond manager, was because they were taking less risk than they could have, right? They were short duration. Oddly enough, their corporate bonds, which some folks think are riskier than treasury bonds, that was also very, very helpful. So you're paid more to own credit risk, and Dodge & Cox will always have more credit risk than their benchmark. So in a market environment where spreads are very narrow, so you're not getting paid more to own longer duration bonds, you're not getting paid more to own corporate bonds, I would say net of fees, 50 basis points per year, right? Which is meaningful. And especially in a down, what I'm really pleased with is Dodge & Cox are somewhat they have the reputation of being a little bit aggressive on seeking out alpha. And sometimes that's difficult in a down market on your returns. So while they add value when the market is going up, they did really well when the market went down. And I'm very pleased with that. So in last year's market environment where it was highly volatile, where there were a lot of things going on, where corporate spreads were widening out, you can expect added value of 150 basis points. That's rare, right? Most of the time, 50 basis points, maybe a little bit more, a little bit less, but that's a good gauge for me. The high yield, you can see it was a tough year there also. Their benchmark's not fair, I will say that. It's impossible to replicate, right? So I would say keeping up with the benchmark there is more the goal. And in an unusual environment, I'd love to see a 1% outperformance per year, but that's not something. Now, on the equity portfolios, again, we're early days here, right? We're early days, and we might see some addition of active managers in there, international. I think that there's some potential for added value. I think that also in the small cap and the mid cap, we've been able to do that successfully in the past, but I don't think there's a lot of rush to do that right now.
Thank you.
Thank you.
Doug, I had just a quick question. Why are the fees higher for fixed income than it is for like equities?
Well, that's normally the case. And let me point out, well, right now for you, it's because you have active on the fixed income side and it's all indexed on the equity side. Normally, that's not the case. Yeah, active management fees on equity are roughly twice as much as they are for fixed income. But that's a good point to point that out. That is unusual to see that.
I had one other comment, and that's that I'm actually pretty pleased with the structure and the allocation within a portfolio. I think the longer term performance, the 5-10 year range, is in line with what we would expect. And the funds that we're invested in, like you said, follow very closely to the benchmarks, which is, again, something that we're looking for. I know that they're index funds and that sort of thing, but it's still, I think it's a solid place to be at this point.
Thank you. Two more things very quickly, and I want to address at one point. Normally, when equity markets go down, bond markets stabilize, and our asset allocation policy that we have pre-written would tell us when equities are down, we would take some of our bond portfolio and put it into equities when it was cheaper. And that's normally very good for risk reduction, and it's very good for return production also. Last year, everything went down. So that did not trigger any of our rebalancing that normally would. That's unusual. I don't recall ever seeing that. You usually have something to do when markets go down because you're reallocating from expensive to cheap. We weren't able to do that. Another thing about the cheap index funds, and this is recognition of political issues right now. State of Oklahoma has said that there are certain investment managers out there that are not doing what's in the best interest of the state of Oklahoma. These are the folks who are anti-fossil fuel. And one of the biggest managers in the world is a company called BlackRock. And BlackRock is vehemently anti-fossil fuel. And so there are a number of states out there, Texas, Oklahoma, Louisiana, Florida, South Dakota, I believe they tend to be energy producing states, have said that you need to divest from those anti-fossil fuel investment managers. And so that is a case that's actually it is going on with some of the statewide funds right now. And in other states, it's pushing from statewide funds down to municipal funds, seeing some scrutiny there. That's not happened here. But I want to say that our investment managers here are not BlackRock. That's the one that's losing lots and lots of money. As big funds like yourselves are having to pull back from that. I think that, one of the state funds has 80% of their portfolio invested in BlackRock funds, and they're kind of scrambling right now. They're index funds, so they're easy to replace, but it's a hassle. Is this political motivated 100%? but you have to comply if you're a statewide fund. But we don't have that issue here. It is an evolving issue, I will say that.
Okay, other questions? Okay,
Teresa, I have
Yes.
just one question.
Yes.
Remind me, who were the first groups that were supposed to get an allocation from the investment trust
so.
for operating expenses?
Right, so first off, remember, we can't allocate anything until we're back at that, at least the 80 million.
Right.
And it really, there's not a timeline of
Okay.
who's supposed to get what. We are working on what that kind of request process will look like. But yeah, so it's not, there's not a timeline of when we are expected to make distributions.
Perfect.
So we're okay so far? Okay. Other questions, comments? Great, okay. Moving on to item 3B, receive the monthly investment report for November 30th, 2022, December 31st, 2022, and we need a correction on the agenda, January 31st, 2023.
Thank you, Madam Chairperson. I'm still making that mistake when I'm writing dates right now. If we go here, the line tips up a little bit during January, so we had positive returns then. Our total market value at the end was $76.8 million, so we're getting closer, and that's good news. The asset allocation was virtually unchanged, but when we look here, month, quarter to date, year to date, these are all the same figures. It's just the month of January. U.S. equities were up nicely. Our small cap portfolio was up the most at 10%. Non-U.S. equities were also up nicely. Performance versus that benchmark looks great. And our fixed income portfolios were also up during the month. When we look at our since inception rate of return, remember at the end of December it was negative 10.97 or thereabouts since inception. So in 1 month, we halved the deficit, if you will, and that was with a 5.89% rate of return. So it was a good month. No unusual issues here whatsoever. Again, the lower risk strategy of Dodge and Cox versus their benchmark did well. The high yield fund, at one point near the end of last year, the high yield bond portfolio had a yield of around 9%. It's been a long time since we've been able to invest in bonds that yielded 9%. And given our return assumption, we will continue to have allocations to fixed income because that's the shorter range portion of our returns. Equities are building the longer term returns in the portfolio. So that is the monthly report.
Okay. So we've received 3 months, these 3 months of investment reports. So we need, unless anybody's got any other questions, we need a motion and a second to receive. Okay, please cast your votes. There we go. You're on presentation. Motion passes. Thank you. Are you on presentation? Okay. Okay, moving on to item 3C, ratify claims for November 2nd, 2022 through February 7th, 2023. Thank you, Doug. Thank you. Appreciate you. We have 3 claims totaling $25,821. The claims are for investment consulting, custody bank services, and our external auditors.
Quick question.
Yes.
Who is the bank? Who is our custody bank? That came up during...
Bank of Oklahoma.
Thank you.
You bet. Okay, any other questions? Okay, please vote. Okay, the motion passes. Moving on to item 3D, acceptance of the annual financial report for fiscal year end June 30, 2022. Amy Parker, our Assistant Controller from the Accounting Services Division, is here to present. Welcome, Amy.
Good morning, Chair, Board of Trustees, attendees. I'm here to present your first audited set of financial statements. So we run on a fiscal year close, the city does. So these are as of June 30, 2022. So we're going to be looking back about 7 months for these financial statements. The Accounting Services Division's goal is to close the books between June 30, and we usually try to finish those up about the week before Thanksgiving, depending on how hard GASB hits us with new implementations. And so we're normally finishing up the audit right about the time you guys have your last meeting for the calendar year. So normally it's delayed a little bit longer. The auditors completed their audit on November 23rd, 2022, and our goal is always to have an unmodified opinion. That's the best opinion you can have, and that's what was issued to OCMIOT this previous year. The report was not comparative because we did not have a prior year to compare to, so it's just a 1-year look at the numbers. If you'd like to read the opinion letter in its entirety, you can find that on page 5 of the financial that was, I think each of you got one at your seat. Just a brief look at the numbers since we're just getting started and there's not a lot to look at. If you look on page 12, which is the statement of net position, you will see that as of June 30, we had $71.34 million in net position. Of course, we would have liked to have seen it go the other way, which it did not, but hopefully when we present this next year, we will be back where we want it to be. So I believe that's really all I had to present as far as the June 30 report, unless you have any questions for me.
Does anybody have any questions over the audit? Okay, thank you very
Okay.
much for being here, Amy. Okay, so take a motion in a second. Please cast your votes. Okay, motion passes. Thank you. All right, moving on to item 3E, acceptance of the internal financial report for the period ending December 31st, 2022. Amy.
So this is your December 31st one, and it's just going to look exactly like what Doug presented to you guys. It's just going to be in financial statement form. So the investments are going the right direction. And if you look on page 5 of that report, we have increased net position to $72.56 million. So we're definitely headed the direction we want to go, and it got even better if we could present financials through January 31st. So
Yes.
that's all I have for December.
We're on the right trajectory.
That's right, that's
Good.
right.
Okay, so we need a motion and any questions of Amy? Okay, take a motion in a second. Please cast your votes. Okay, the motion passes. Thank you. All right, moving on to item 4, comments from trustees, staff, and interested parties. Do we have anybody signed up to speak? No? Brent?
To recognize the accounting staff and how much we appreciate them for their efforts in putting all this together. And also appreciate all that Treasury does here to help us, hopefully in the future, make some money on this trust. So, but thank y'all.
Yes, thank you. Sometimes it's harder to do accounting when it's not going in the direction you want. So thank you very much. Yes. Anybody else? Any other comments from trustees, staff? Yes.
Yes, good morning. Just wanted to give an update. So the city of Oklahoma City is switching banks. The selected vendor was Bank of Oklahoma, so they are going to be the new banking services provider. That will also roll down to this trust. And as part of that, there will be a change in the money market instrument that we utilize. Doug mentioned that in his presentation. We'll be going to a Goldman Sachs government fund. With that, we will have more information of that in the future, but I just wanted everyone to be aware that that's a city change, that we're changing our banking services, and that will impact this trust.
Interesting. Good. Do you need any questions?
Well, aren't we already with Bank of Oklahoma?
We are.
City.
That's our
The entire
custodian
city
bank,
is
so, yeah.
switching to Bank of Oklahoma.
Yes, and that there is a distinction between the custody bank,
Right.
For just keeping the safekeeping for those investments versus our primary day-to-day banking where cash would be held.
Okay.
Any other questions? Okay, thank you for that update. It's good to know. Any other comments? Okay. Seeing none, item 5, we are adjourned. I don't use the gavel.